I actually think that Bitcoin's one of the riskier cryptocurrencies to be in right now, which is very counterintuitive. It's that we could see a Bitcoin miner capitulation. From a broader perspective, I am a bigger fan of Ethereum right now. There's three types of pivots if we want to break it down.
And as you can see, we have a very special guest, an OG coming back with us. Forrest, how you been?
Doing well, Ian. How about you?
Doing well, doing well.
Thanks for having me on.
Absolutely. Let's hop straight into it. Let's actually begin with Forrest, because Forrest is more of a trader, a technical analyst. I'm more of a long-term value investor. So Forrest, in terms of the month of December, what are your predictions for Bitcoin? Obviously not financial advice.
Sure, yeah, of course. So I'll pull up the Bitcoin chart here, and we'll throw on a couple of indicators that I like to use. So first off, we've got our easy bands. These are very similar to like Bollinger Bands, using a little bit of a different methodology, but you can see that the strategy is simply to look to accumulate Bitcoin when it's very, very oversold, or any cryptocurrency for that matter. And actually, despite making new lows, we're only a little bit oversold. We're only a little bit below our 21-week simple moving average here. So in general, if you follow a DCA strategy, personally, I would prefer to be buying or DCAing in when Bitcoin's below the 21-week simple moving average. If you follow a long-term strategy, if you're following a shorter-term strategy and you're looking to get into some sort of a momentum trade, you can look for a breakout above that 21-week simple moving average and ride it up in a bull market. But for right now, this is more of a longer term viewpoint, or a longer term time to be looking at Bitcoin, because we are below the 21-week simple moving average. Now, I'll get rid of that indicator, and I will just briefly look at RSI. RSI on the weekly can be a very, very good signal, both the top signal and a bottom signal. And we've recently printed bullish divergence on the RSI. So in the short term, that would indicate that Bitcoin may have found a bottom. And what I mean by may have found a bottom, may have found a local bottom. It doesn't necessarily mean that Bitcoin's going to rip up into a new bull market from here. In fact, I don't think that's likely at all. I actually think that we're probably in for a longer bear market, and we're just going to have to play the cycles for Bitcoin. Look for March of 2024 is the next halving. But I do think that we could get some constructive price action from Bitcoin here in the short term in December. Now, the thing with Bitcoin at the moment is I actually think that Bitcoin's one of the riskier cryptocurrencies to be in right now, which is very counterintuitive. The reason I don't love Bitcoin right at this moment is because, and I do think it's fine. We've potentially found a local bottom. I think there's a little bit of risk in the sense that we could see a Bitcoin miner capitulation. Basically, we've got a lot of Bitcoin miners out there that are over leveraged, or they've taken on debt in order to maintain their operations. And the longer Bitcoin's price stays suppressed or down, the harder it is for them to actually be profitable. And if we actually see some of these Bitcoin mining operations go insolvent or shut down, they may have to liquidate and sell a large portion of their Bitcoin if they have any liquid Bitcoin. Again, that's being a little bit more risk averse, but it's definitely something to be aware of. Bitcoin's got some resistance at 16.8K. These are margin pressure levels, but we've actually let me move into the daily. We've actually broken above our 16.8K resistance, and the longer we hold above this and hold support on top of it, the more likely we are to be able to come up and see a retest. Now, I think a fairly strong base case here, if we move our levels over one more notch, is just to see some sideways chop within this range. Right, sideways chop within this range between our 4x short and our 5x short margin pressure level. And the reason I say that is because if we go back to our previous local high up at around 32.3K, if we go to our 24K high, that is, we see that this 4x to 5x short range is a very popular level. In fact, I believe we spent a total of maybe 100 days in that region. about 60 days. So you see a lot of chop in this region. And we deviated above it, had the FTX collapse. But right now we're doing something very similar off of our last local high, where we're actually ranging in this 4x to 5x zone. We may look for a deviation above it, and then we just have to play the breakouts. From a broader perspective, I am a bigger fan of Ethereum right now. I just think in the long term, Ethereum is going to outpace the gains of Bitcoin, higher Sharpe ratio, and just better overall fundamentals, in my opinion, than Bitcoin. I will throw on our margin pressure levels here and show you the key support and resistance levels that I'm paying attention to. We have strong confluence in these two levels, 1340 to 1350, and then again at 1500 or so. So I'm looking, well, right now we've actually recovered our range, our consolidation range that we were in for about 60 days or so before we started pumping up. What I'm looking for is hopefully a recovery of 1340 and building of support on top of that, which would allow us to go up and test 1500. In the short term, however, we do have a ton of resistance at 1340, 1350 from a short-term perspective. I think hedging at 1340 to 1350, maybe looking for a little bit of a short, maybe de-risking a little bit is probably a fine strategy. And then the last thing I'll say, I covered Bitcoin and Ethereum. The last thing I'll talk about is just the overall legacy market, because and this matters for crypto. I like spending a lot of time analyzing crypto. I don't love the legacy market nearly as much as I love crypto. That's why I'm in crypto full time. But we do know that how the S&P 500 performs, how the legacy market and bond markets perform, can affect risk assets like crypto. We're currently at a point in the S&P 500 that we're running up into just our linear resistance downtrend line. This is an extraordinarily good time historically to de-risk. And what I mean by de-risking, I don't mean like selling everything, selling your entire portfolio. I definitely wouldn't recommend selling your 401k if you have a long-term time horizon. Time in the market beats timing the market. But if there's any long positions or like short-term trades that you're in, may not be a bad time to consider taking profits on risk assets and maybe rotating them into something that's a lower risk strategy like bonds. We could definitely see a building of support on top of this downtrend line and maybe move higher, at which point you can always buy back as support on the other side. We don't necessarily have to hold and hope that we break through. We can de-risk a little bit, and if we start breaking back down again, we can get in at lower prices. Alternatively, we can buy on the back of that downtrend line. Now, I've briefly mentioned the bond market. The bond market's really, really important right now. We have our yield curve here, and I know this is a confusing chart that I won't necessarily walk through how it works fundamentally, but what you do need to understand is that when this yield curve inverts or crosses below this white line, which is our 0% level, and the yield curve goes negative, this is the 10-year yield minus the 2-year yield of US Treasuries, that usually indicates a coming recession. And this over here is just our 10-year yield. But when you overlay these levels, you're going to see that the 10-year yield usually crashes following an inversion of the yield curve. And what you can see right now is that we're actually very, very negative right now. The yield curve has not been this inverted in a very long time. If we've only got data back to the 88 on this chart, but this is a very massive inversion. And what I would expect to happen is that this is going to pressure the Fed to start pivoting sooner. And we've already gotten our first kind of quote unquote pivot. That word Fed pivot is overused a lot. There's three types of pivots if we want to break it down. There's a pivot in sentiment from hawkish to dovish. That's what we got this week with Jerome Powell coming out less hawkish and more dovish than he normally is. Then you have a pivot where you go from aggressive rate hikes to lowering the pace of rate hikes. And then you have our hard pivot where we move from rate hikes to rate cuts. What you'll see is that historically the market bottoms, the S&P 500 bottoms 6 to 12 months after a Fed pivot. And what that pivot is in that case is a hard pivot. In the meantime, however, I'm actually a little bit constructive on the market. I think this market's going to like the reduction in rate hikes. I think we can actually, it's like kind of releasing the pressure valve of these rate hikes, we could start to see the market flow up a little bit. But as we move to a point where eventually the Fed's going to have to make a hard pivot and actually start cutting rates, and I know they are saying that they're going to keep rates elevated, but if something breaks and there's an indication right here that stuff is already breaking in the bond market, they may have to cut rates sooner than they want, which is not ideal. And that could send us into either a recession or some sort of stagflation. What I'm saying here is that bonds are actually looking pretty decent. Right? We see historically bond yields drop. And when bond yields drop, that means the underlying premium is going up, right? So the 10-year, we would expect as we start to see an uptrend in this yield curve, we'd expect the yields on the 10 years to drop, which would mean the base premium would be increasing and you'd actually be in a very constructive asset. So the last chart I'll show is that this is simply TLT. This is a ETF for long-term treasuries. If you're looking to invest in like the 10-year, 20-year, 30-year, we're actually starting to see a capital rotation into bonds as a traditional risk-off asset, which has actually performed really, really poorly this year. All that to say, we covered Bitcoin, we covered Ethereum, we covered the legacy market. Historically, a strategy of diversification over the last 10 to 15 years hasn't been the best strategy. In fact, the best strategies over the last 10 to 15 years has been to be allocated towards risky growth stocks, tech stocks. Crypto has outperformed everything over the last 10 to 15 years, and real estate. If you've been in bonds and you've had diversification in your portfolio over the last 10 to 15 years, you've actually underperformed the market. However, we're moving into a point where recession is potentially on the table. And this is making me more bullish on a strategy of diversification. And I do think that having crypto is a very important part of that diversification strategy. That just has a higher beta, higher potential. But I'm more bullish on a diversified portfolio right now than I have been over the last several years. So we'll leave it at that.
All right. Definitely great analysis for us. So I want to share this quick picture from a tweet from Alessia Rostani that's been kind of going viral and get your thoughts on this. So basically this says that the majority of the decline in bear markets has occurred after the Fed's pivot. So looking at this chart, basically from 1969 all the way until 2019, every time the Fed pivots, there's been basically a crash in the markets. So what do you think is going to happen kind of looking at this? Do you think that this is going to play out again, or do you think this time it'll be different?
Kind of reiterate, there's like three, that word Fed pivot gets very confusing because people define it differently. As we see in this chart, this is showing when the Fed actually starts to cut rates, not just slowing the pace of rates. So I do think that the market can kind of float up a little bit, and you actually see that pattern where when the Fed kind of flattens out and just holds rates, or they start to decline the pace of rate hikes, the market still does okay. And where it actually tops out is when they start cutting rates. And usually the Fed cuts rates because something's already broken in the market. So I do think that this can play out again. But what we need to pay attention to is when the Fed actually starts cutting rates versus just slowing down the pace of rates. And right now, it looks like they could be cutting rates maybe March, April, May. They say they want to hold rates and keep them elevated for a while, but I think they're going to be forced into a harder pivot if we continue to see the bond market react the way that it does. The other thing that I'll say about this time, and I know the deadliest words you can say as an investor is this time is different. But if we look objectively at what's causing this crash in the market and what we're actually seeing this time, there are some different variables. You look at the dot-com bubble. Dot-com bubble was caused by over speculation in basically tech stocks, dot-com stocks. If you look at the real estate crash or the financial crisis of 2007, 2008, you actually see that was caused by essentially bad debt, mortgage-backed securities and whatnot. Now, this crash, this pullback that we've seen in the market is really directly related to QE and QT. We had record quantitative easing followed by record quantitative tightening. What's drawing back the market right now is quantitative tightening. It is rate hikes. So when you actually flip the script and you reduce the rate of those rate hikes, I think in the short term, the market's actually going to like that over the next few months. And then we need to be careful about, all right, these rate hikes, what is it breaking in the market? And once we identify what it's breaking in the market and the Fed actually pivots hard, that's when we need to be careful about these 50% or 30% drawdowns that we see. So I do think that this will play out, but we do need to pay attention. Timing the market is tough. I do think that there's room to chop or maybe go up a little bit in the short term.